Hey, it's John Hobbs here, Senior Analyst at Income Shares and Leverage Shares. Welcome to the second video in our series on options income ETPs, or exchange traded products. In this video, we'll give you a breakdown of one of the most widely used income strategies in the options market, the covered call. It's a fairly straightforward idea. You hold a stock or asset and you sell a call option on that asset to generate potential income. So, let's get started. Here's what you'll learn in this video. Number 1, what a covered call strategy is and what it aims to achieve. 2, how the covered call strategy can behave in different market conditions. And number 3, how covered call exchange traded funds and products typically work. And finally, number 4, the key risks to know when considering covered call income strategies. Okay, so let's start by explaining what a covered call options strategy actually is. And to do that, we're going to use a simple example with gold. It's a two-part strategy. On the one hand, the investor holds some gold exposure. This could be through a gold exchange traded fund. So now the investment has some upside potential if the gold price rises. Then there's the next part. The investor sells call options on that gold exposure. When investors sell call options, they get paid options premiums up front, and that can become a source of income. So, adding the two parts together, we get the covered call strategy. That's where the investor essentially sacrifices some upside potential on the gold price for income generation. But more on that later. And a quick side note before we go on. A call option is an option to buy a stock or asset for a specific strike price at some point in the future. You can learn more about call options in this first video in our options series, and I'll leave a link to that in the description. Let's now walk through a simple example of a covered call strategy. Assume ABC stock is trading at $100 a share, and Jack owns one of those ABC shares. Jack decides to use a covered call strategy on those shares, and he's happy to hold the stock and sacrifice some of the upside for potential income. So Jack sells a call option on ABC stock to Jill with a $105 strike price. Jill then pays Jack $2 for that call option. That $2 gives Jill the right, but not the obligation, to buy ABC stock from Jack for the $105 strike price. Let's now fast forward to the end of the strategy, or the option expiry date. Here, one of three things can happen. If the stock is above the $105 strike price at the end of the contract, then it would be profitable for Jill to use the option. So she buys the share at $105 from Jack. That's good for Jill, but for Jack, it's the opposite. He has to sell that stock for $105, even though the market price is now higher. So his upside from the stock price stops at $105. But it's not all bad news for Jack. He still keeps the $2 premium from selling the call option to Jill up front. Now suppose the stock is trading at exactly $105 at the contract expiry. That doesn't benefit Jill, so she won't use the option to buy the stock for the same $105 strike price. But Jack, meanwhile, keeps his ABC share and the $2 premium. Finally, let's assume the stock falls below $105 at the end of the contract. Again, Jill won't use the option because it's not profitable to do so. So Jack keeps the share as well as the premium. So to sum up, Jack always keeps the premium, but he only keeps the share if the stock price finishes at or below the strike price. Let's now go through a hockey stick diagram to explain the difference between simply holding ABC stock and using a covered call strategy on the stock. So if Jack just owned the stock, his profit would rise and fall one for one with the stock price. In theory, the price could keep rising, making his profit potentially unlimited. And if the stock dropped to $0 from $100, his maximum loss would be $100. So how does this compare with his covered call strategy on ABC stock? Well, Jack's maximum profit would be $7. That's made up of the $2 premium he got from Jill, plus the $5 stock price increase up to the strike. And that's where the profit buck stops for Jack, since he sells ABC stock if the price goes above the strike price. On the downside, though, Jack is still exposed to the $100 loss if the stock drops to zero. But he does keep the $2 premium as a consolation prize. So in theory, his maximum overall loss is $98. Of course, in reality, the stock price might not move to such extremes, so the option premium can help cushion Jack's downside. So let's apply that theory to the real world. Here's how the covered call strategy might compare with holding a stock in different market scenarios. In a bull market, it often lags a stock because the upside is capped at the strike price. In a bear market, though, it can outperform because the premium income helps buffer some of the drop, but there is still downside risk. In a sideways market, the covered call strategy tends to do its best work. That's because the strategy can keep earning premiums even though the stock price is going nowhere. That's why investors typically use covered calls for income and more stable returns, not for chasing big upside moves. Covered call ETFs and ETPs can automate this whole process. The fund holds the underlying stock or asset. It then sells call options on that asset, which allows it to collect income premiums. The fund can then distribute that income to investors. It's worth noting that inside the ETP, the process is usually systematic, and income also varies over time because option premiums move with volatility. Higher stock volatility means higher option premium potential, and vice versa. Before we wrap up this video, here are 4 main risks of the covered call strategy. First, the stock can still fall. Covered calls reduce losses only by the amount of premium earned. You still carry stock price risk. Second, the upside is capped. If the stock rallies, you give up potential gains above the strike price. Third, income isn't guaranteed. Options premiums can change as volatility changes. And fourth, all income funds have what's called NAV erosion risk. That's when the value of the ETP shares could erode over time if too much income is paid out and trading losses stack up. You can learn more about NAV erosion in this article, What Investors Get Wrong About NAV Erosion. Link in the description. So that's it for this video, and here are the key takeaways. Number 1, covered calls combine owning a stock or asset with selling call options to generate potential income. 2, the strategy may lag holding a stock in strong bull markets, but it could outperform in sideways or falling markets. Number 3, income changes over time because option premiums move with volatility. And finally, number 4, upside is always capped, and the stock can still fall, so investors still face ongoing risk. Thanks for watching this video. To learn more about options income ETPs, check out the related videos and articles linked in the description. And if you'd like to go a bit deeper, feel free to sign up for our mailing list. You'll also get a free copy of the Income Shares PDF guidebook when you do. You can also subscribe to the channel for more educational content on options ETPs.